So, what is liquidity? It's because I never put enough time for Q&A, so don't worry. We're going to speed through today, then have lots for Q&A. So liquidity, I guess there are two ways to think about it. There's the Michael Howell way of liquidity, looking at liquidity, and then the older way of liquidity. So if you're, first of all, let's look at the older way of liquidity. So if you have a market and people say there's deep liquidity there, what exactly does that mean? It means that there's an asset whereby you could pump shitloads of money into it, you could buy or sell loads of it, and it will just absorb it and not budge the price. So an easy way of saying it is that you can measure the liquidity of an asset by how much of an order you could put in and not move the price. Does that make sense? Like if you go back down, like last year with Casper, you could put a 40 grand buy order in, and what would happen to the price? It would go up 1% or 0.5% or whatever. So you could say that has a very low, that's a low liquidity asset. It has a very shallow order book. Whereas now, a 40 grand order doesn't even budget. I forgot the actual numbers, but I think I bought something like £500,000 worth of Casper the other day. The price did not move, not even a bit. And I was like, this is amazing. Because it also means that in the future, Q4 next year, when we start phasing out, it hopefully also means that we won't be dumping the price as all of RT starts phasing out over a period of a quarter, and everyone trying to front run everyone else. So yeah. So what I will be saying is that I'm not going to be telling you when I'm selling. I'm just saying now it will be Q4 next year. That's it. I know Michael's, he's going to be selling before that, but yeah. And it shouldn't be just one bullet out. It should be an orderly phase out. And maybe even do it in terms of, shit, Tao just hit $5,000. Let's, snatch a bit of profits off there. Or every $1,000 it goes up, just take a little bit off. You can't tell yourself off or berate yourself for taking profit. And I think many veterans here have gone through many cycles where we haven't taken enough profits off as we get into silly season. So going back to liquidity, that's the old way. So the reason why a lot of people buy US debt is because it's the deepest market on the planet. You could buy $1 billion worth of treasury bonds, buy or sell. It doesn't budge the price of the bond. So that's typically how people look at it. But what Michael Howell from Cross Border Capital looks at it in a different way, because he's seen some charts, or he's created some charts, which you will see, which basically prove that the markets are a bit of a sham, or which we already know that, but they move completely due to liquidity. So when the central banks are printing, assets go up. When they stop printing, they go down. It is as simple as that now. So when I look at liquidity these days, it's basically, I look at it in the view of currency flowing into a financial market, not the economy, okay? So, yes?
You know, we see market depth, and it's like plus, -2.
Yeah. Yeah, that's more order book depth. So it means, so if you look at a random crypto and it has a plus or minus 2% depth, it means, and let's say that's 50 grand, it means if you did a 50 grand buy order right now, it would move the price 2%. That's typically basically what it means. Hello. So, pop quiz, what's liquidity, you two? no, Joe. Welcome, have a seat. Yeah, so this is basically it, and this last bit is very important. It's currency flowing into financial markets, not the economy. Okay, so this is why you can have your QE, QS, etc. Pumping into the financial markets, but economic metrics aren't changing, okay? So the economy will have a second, third, fourth order consequence improvement once the liquidity starts coming up. But unfortunately, it just goes straight into the financial markets, i.e. bonds, stocks, real estate. And so, yeah, it only helps the economy once all of that, comes down. So what? Why should we care if liquidity is just money or currency going into financial markets? Well, this chart I think is quite interesting because you can see that As time goes by, the correlation between liquidity and the financial markets gets closer and closer. So if you go back to the 90s, there was only a 0.57 correlation. So it meant that the financial markets, the stock market, etc., sort of was like, meh, whatever. It was independent, let's say, of global liquidity. But then as we start getting into sort of the 2000s onwards, we see an increasing correlation of 0.84. The correlation right now is well above 0.9. So it's basically a perfect fit now. So whatever liquidity does, the financial markets follow suit. And I mean, you can see it here, like liquidity is the orange stuff, all wealth, so this is financial markets is the black stuff. Look at liquidity, it starts spiking, markets follow, and it is in lockstep now. So I wouldn't be surprised if we saw an updated chart of this and it's like, 95% correlation. In fact, is it correlation or is it causation? I think it's both. Yeah, it's both. But how is it linked? So this needs a bit of history. So if you go back to the late 90s, we had in 1998, LTCM, long-term capital management, went bust. And that changed the world forever in the financial sense. So how did they go bust? So in the in the mid-90s, we had the Southeast Asian crisis. So Indonesia basically went bust, Thailand went bust, and the Thai baht had a bit of a massive wobble. It basically just it folded. And so we had this mass contagion in Southeast Asia of loads of countries just going, oh shit, we're buggered, sorry. And that had a spill-on effect with the Russian ruble. So the ruble defaulted. So the Southeast Asian pandemic rolled over into Russia, and the Russian ruble defaulted, or Russia defaulted big time. And what happened is that loads of hedge funds in South America went bust. Like, all of South America just went bust because of Russia going bust. And then everyone thought, okay, this is contained. It's only Russia. It's only South America. It's fine. But what no one realized is that pretty much loads of American hedge funds were all in on South America at the point. To the point where LTCM, long-term capital management, was the biggest hedge fund in history. It was called the super hedge fund. It was the Titanic of hedge funds. They had all of the best mathematicians in the world. They had black skulls that ran their business models. And if you get really geeky, there's lots of black skull. There's two blokes called Black and Skulls, and they came up with loads of mathematical models, which the financial world still uses to this day. Anyway, Black Skulls was in LTCM. They literally got the glory boys of the financial world, put them in one hedge fund and went, here we go, let's own this. Jim Rickards was in LTCM as well. I think he was part of their legal team. But guess what? The Titanic of hedge funds sunk. LTCM went bust. So what happened is that the big US banks had to come in and bail them out. They're like, oh shit, if LTCM goes properly bust and is allowed to go pop, the economy is hurt. US civilians will get hurt, yada, yada, yada. So loads of smaller banks in the US basically gobbled them up. There was a big fire sale of LTCM and all the assets that it had, and they had to be gobbled up by the banks. So that was sort of contained. So you now had a whole bunch of junk debt and junk assets all gobbled up due to LTCM. Then we had the subprime mortgage collapse. So you then had this massive turd, which is, basically, subprime mortgages being all rolled up. You had CDOs and CDSs. So you had CDOs, which is collateralized debt obligations, where you're getting really shit property, bunching them up with it's like The Big Short is the best analogy. It's like you have some gone off fish, but you sort of put it you turn it into a fish stew, and hopefully no one notices. Or you put some really gone off fish with some okay fish, and hopefully it's all right. That's basically what they did with junk bonds. They got really bad, delinquent properties, put them all up, wrapped them into as an asset, and then they started, caking them in with B grade, A grade bonds, and then it all just went pop. So what happened is that you had all of these banks with all the shitty LTCM junk from that going bust, and the subprime mortgages, and there's no one left to bail the banks out other than the Federal Reserve. So now, the Federal Reserve had to come in 2008, 2009 and go, all right, we'll buy you, we'll just buy everything. So this is why, going back a bunch of slides, the Federal Reserve has sat there on loads of mortgage-backed securities, and they're now dumping them because they need to dump them to get money to buy more debt, to buy their own lemonade from their own lemonade stand. So everything is linked from that Southeast Asian pandemic or currency pandemic, and it's gone all around the world. And this is why everything is now correlated. So basically from the late 90s and the tech bubble popping, oh yeah, we had the tech bubble crash in 2000, 2001. So lots of other companies needed bailing out. And it's really since 2001, the world has been gorging on liquidity. Well, it's just the world copies whatever liquidity does. It's really from here that we're sort of, liquidity is our new god. And that's LTCM going bust in the late 80s, late 90s. And this, I think, so the question I keep asking myself is, okay, what sort of event would depeg this? And I can't see much. I think the only thing that would stop this chart from being pretty much bang on correlated is a debt jubilee. That's pretty much the only way that they have to change the system somehow. They have to just go, yeah, we're just not going to pay this debt anymore. We're just going to have some hard times. But I can't see that happening. Basically, the only, if Javier Milei was the US president and started changing stuff, that's pretty much the only thing that would stop this chart from being correlated now. So is it likely to continue? Yes, it is. And the other reason is that we have this other thing which is forcing this correlation, and it's global debt. So I know the US is 35 trillion, but there's $350 trillion worth of global debt. That's nuts. And there's lots of fuzzy figures around global GDP. Some people say 200 trillion global GDP. Credit Suisse, I think, recently said it's closer to 250 trillion GDP. And that, not GDP, all global wealth. That's including all real estate, all financial markets. So people are roughly saying it's between 200 to 250 trillion, all wealth. Well, we got 350 trillion in debt. So, so we look at the US charts thinking, the US is so irresponsible. It's the whole world. It's us. The UK is actually just as bad. Now, the reason we are on this 5 to 6 year liquidity cycle is because all global debt runs on a 5 to 6 year terms basis. So obviously you have the 2-year, 10-year bonds and the 20-year bonds for the US, but that's a relatively isolated chunk of global debt. When you roll up all of the global debt, and this includes private debt, by the way, this includes your car loans, this includes mortgages, it includes everything, and the biggest chunk of that is corporate debt. Because
it's not just the debt each country.
It's everything. Everything. It's from.
It's all over to what these global central banks.
It's everything from the sharky payday lender to the US government bonds. But what's happened since 2000, since tech bubble, I guess, yeah, really, let's say after tech bubble popped and things started recovering, from 2004, you had very crony capitalism where they were where interests were relatively low because they're out of the tech bubble, they had to dump rates. What happened is that big corporates realized, wait a minute, we can borrow almost unlimited money at 0.5%, 1%. We can go in and buy back our own stock or just go and buy stuff or even just borrow at 0.5% and put it in some bullshit, the least dodgy asset possible and get 4%. And make an easy 2-3% ARB. They're like, this seems like cheating. So let's go and borrow $1 billion, pretty much free. Let's buy back our own stock. Okay, that was pretty cool. Let's do it again. And so from 2003 onwards, that's what basically every big company has done. They've just been borrowing, because if you have a facility to borrow at less than 1%, why wouldn't you? Even if things are going well, you'd still borrow, wouldn't you? Because if you're a good company, or no, even if you're a shitty company, you should be able to make more than 1%. So the world has been gorging on debt for the best part of 20 odd years. And when you look at all of those debts, from the payday lender to big debt, it's a 5 to 6 year terms. This means every freaking year, the globe has to refinance $70 trillion worth of debt. Every year. A 70 trillion refi, which is nuts. So when you have stock market crashes, it's not a stock market issue. It's the globe's inability to roll over and refi. That's it. You just have one bad year where no one wants to refi or roll over, shit hits the fan. So the global liquidity cycle is actually the global debt refi cycle. And I don't see many people talking about this. And this, it makes so much sense when you sort of peel back the layers. It's just the global debt refi cycle. And you need liquidity in order to roll over the debt. Now, not liquidity as in market depth or order book depth, liquidity insofar as we need someone to start pressing 1 and 0, 0, 0, 0, 0, 0, enter. We need someone like a central bank, all the central banks, to start pumping, because unless they pump, remember, there's way more debt than GDP or anything. So the only way we can get a refi of a big scale is liquidity, as in pump. So this only adds to my smooth brain bullet point cycle. This literally almost solidifies it. So you have to get more liquidity to roll over that debt. So yeah, and if you can't roll over that debt, guess what happens? You have crashes. What's happening right now is the US government is struggling to roll over their debt. So this is a biggie. The fact that Russia and China and India have all gone, yeah, we don't really want to buy US bonds anymore. We've got enough. China has more US denominated assets than America has. Like, they've got enough. They realize that they're holding a massive turd and the US dollar is dying. They don't really want to do that. And they also know it's asymmetric warfare from a financial sense. They realize, like, have you seen, I see it quite clearly, but because I follow this stuff, but have you seen that there is a massive chasm forming between the West and the East? I mean, we've sort of slowly seen this over time, but the BRICS nations, they're really accelerating that divide now. They're all talking about having a BRICS currency of some sort. And you know, it's not just BRICS, it's BRICS plus 20 other countries. But it's the BRICS which are the biggest ones, mainly Russia, India, China. But they've just created a new pipeline. Have you seen? There is a new pipeline that goes from Russia down through Iran, down, all the way to India. And like, it's so far away from the Western sort of borders, like no one can access it. It's not through the ocean, it's literally through all the countries now. They're doing all sorts of bilateral trade. And it's almost as though that the BRICS were in their own little WhatsApp group going, here's how we could really fuck over the US. Let's just stop buying their debt. Let's see what they do then. And that's what's happening. So the US is really struggling to sell more debt. And we all know they have to refi every year a big chunk. Obviously not 70 trillion, but whatever the US chunk of that is. And it's a lot. It's going to be a lot. You could probably work it out. If they're 35 trillion in debt, with a bit of time and a calculator, you could probably work out how much each year that they need to really refi. So, yeah. And then it just leads back to these charts. And, you know, we've had a sustained period of rising interest rates, which again slows down liquidity. So right now we're all moving into a focal point where the world is really struggling to roll over to debt right now, and they're just gagging for the central banks just to please shower us with money. But they haven't done that yet, and the longer that happens, the worse this whole predicament comes. So if you can't roll over the debt, what happens? People get liquidated. People, companies, countries get liquidated. So assets are seized, forced sold. That then dumps prices. Insolvencies, liquidations galore, mass job losses, and therefore recessions. And that only means print, print, print. So when the shit really hits the fan, we know that the knight in shining armor is Jerome Powell. We all hate him, but he will basically be the person, the sole figure on this planet that will pump our crypto bags into Valhalla. Like, it was just, yeah, literally. So it's this really horrible thing that we sort of want the world to fall to shit to pump our crypto bags, which sounds dreadful. I'm not going to complain, though. So going back to this slideshow, which I would just pump into your brain every week, every trading pub. Aging population plus falling economic output equals lower GDP. Simple, simple math. It's simple arithmetic at this point. Lower GDP means tax hikes and more borrowing to service the deficits. Pretty much every government is talking about tax hikes at the moment. The UK, we talked in the trading pub the other day, how the UK is planning on, bringing CGT in line with income tax, he said, yeah. So if you're an additional rate earner, that means you're 45% CGT. Anyway, more borrowing. Okay. Sorry? Don't tell him. There's a lake here. We should all go on a boating trip and accidentally lose our seeds. Ah, I lost all my crypto on Why Boston Lake. I've got many witnesses. Yeah. Anyway, yeah, I can imagine lots of boating trips and people losing their crypto. Sorry? I know, yeah, it happens. You know, if you bury it underground and, yeah. I actually know a guy who buried his silver, he had a lot of gold and silver, in a small stream in his garden. He went to recover it like 5 years later, it was gone. I was like, why the hell would you put it in flowing water? He was like, I put it pretty deep down. I didn't think water would affect, it wasn't there, it's gone. And he doesn't know where it is. He was like, my silver is somewhere from here that way. But the silver's not worth enough for him to get an excavator and start digging, because silver's rubbish now. Yeah, but he was like, if gold and silver ever do spike, I'm going to get an excavator, and I'm going to, just... Probably, I guess, yeah.
Give your kids a job. Give
Sorry?
your kids a job.
Give your kids, yeah. It's not me, by the way. I do have a small stream in my garden. It's not me. So I'm not that stupid. What was I going to say? Yeah, so where are we? We are literally here. I keep saying this. There's an arrow right here. More borrowing equals, so we will need more borrowing, which means we need rate cuts. That will happen. I promise you. Give it a couple months, at least 1 quarter, we'll see the US start cutting big time. And then they'll start the crazy stim pumps, which means more liquidity, yes. And by the way, obviously the markets are conniving, so there could be a mini stock market crash in the time being. So I'm not ruling this out. We could get a very short-lived stock market panic where stuff just starts dumping, which means Bitcoin could temporarily pull back to 55, 60, and that will scare the shit out of everyone. But if that happens, it is not the big one. It will be a short-term risk-off play, and that short-term risk-off play will scare enough people that it will then start crazy stim pumps. So it will almost be like a false high, okay? So this is my warning. If we have a mini stock market crash in the next 6 months, it's not the big one. It's the pre-tremor. It's the thing that will force every government to start printing like crazy. And it's almost, something to force the Federal Reserve to go, okay, come on, let's create some new term, quantitative support, and pump, helicopter money even. So just be aware, that's going to be a little faint Don't fall for it. That right hook will come, but it's closer to end of 2025. So more cowbell means we as a community are happy. But yeah, unfortunately, the dollar just gets weaker and weaker and weaker. And it will get to a point, probably, I don't know, it could be 5 years, it could be 10, 15 years, where there will be a point where people won't accept dollars for Bitcoin. You know, there'll be people going, hey, I've got $1 million, I want to buy Bitcoin. Nah, the dollar's a bit shit. And it's inflating pretty fast. And then you'll have this weird bid up process where you see in hyperinflationary countries where assets just get bid up massively because people just lose faith in the currency. It's probably not 5 years. It probably, maybe, let's say within 10 to 20 years. But at some point it's going to happen where people just won't accept dollars for the Bitcoin. And that's when we'll see the crazy 1 million, 10 million per Bitcoin, or, yeah. So, and yeah, weaker money exacerbates all the previous points. It's rinse and repeat. This happens all the time. And we just go back to this chart here. This shows us everything. And the best chart, which I found recently, this is a new chart I found, Bitcoin against global liquidity. Whew. Look how closely that is. So Bitcoin is a very sensitive asset to the liquidity markets. Very sensitive. And that's mainly because Bitcoin is still a risk-on asset. So when people are bullish on stocks, they'll all say, oh, I'll have a little flirt with Bitcoin. For the moment, it's a risk-on. I think at some point, Bitcoin will become a hedge, and then we'll see that correlation break off, where people go, okay, the world is actually falling apart, let's buy Bitcoin. As more and more countries approve it as legal tender. But that is, yeah. So the interesting thing about this chart is look at this little uptick in liquidity here. That's the beginning. That's not like a little up and down. That's the beginning of of another leg in global liquidity, which means Bitcoin should react accordingly. So that is, I guess, the cross-border capital sort of version of liquidity, and it's the thing that makes most sense. What time is it? 11:30. Phew, I'm really early. So that's break time. Or any questions before we go for a nice 30-minute break? Yes?
Big crash, not the mini crash,
Yep.
comes at the end of the smooth break points, just to be, yes?
Yeah.
Okay.
Yeah.
So we're not expecting a big crash before we're out?
No. So I think we'll have maybe possibly a fake-out crash, which will basically, because they're very reluctant to press the print button at the moment. They're doing everything possible to keep rates as high as possible. They keep posturing and, in press conferences, go, oh no, we've got to keep inflation at bay, we're going to keep things up. But I think someone's going to force their hand, or the market will force their hand. Asset prices will start dumping. They'll be forced to print. And it's when you start seeing the crazy printing that, well, see, I don't know whether we do have a fake out. So we either have a mini fake out, starts the printing, and then we have the proper crash, which you can't kick the can down. Where is that chart gone? No, is it this one? Yeah. So ultimately, the big indicators are showing a big recession. So I think there's only two scenarios. You either have this mini crash just to kickstart the pumping, and then this crash will happen anyway. Because remember, when interest rates start cutting, it normally leads to the big crash. Or they do just kick the can down the road for another 6 months or so. But I do see 2025 being a bit of a weird year with, yeah, the honest answer is I don't know. I just know that I hear tremors, and I don't know how, is it going to be an earthquake or a volcano? I don't know. But I'm pretty confident this chart's not going to break here. Like this, the trends that we see in all these three charts, that will be solid. But
if we hit recession before then obviously a major recession, everything will go down and it won't be.
yeah, it's hard because
Next year.
Because history, it doesn't repeat itself, but it rhymes rather well. So the textbook, the textbook scenario should be a big recession, as in an economic recession, once we've seen probably at least 2 quarters of heavy cutting. After we've had, if we just take this bit here. So here we've got probably 2 or 3 quarters of cutting, in fact any of these really, and then the economic crash happens. So the economy starts breaking and falling to bits, and it's then they start printing. Okay, so they don't, remember, it's not both at the same time. It's rate cuts, rate cuts, rate cuts. Something breaks. You then see the unemployment, the U1 number, start to spike up. So U1, so this unemployment number is U6. So if we find U1, this is the most sensitive one because it's the 15-week. Come on, computer. Oh. Exit. Here we go, 1 second. If we go back to that one. So this is the U1 chart. This is the most sensitive one. So economy break, so rate cuts, economy break, something happens. U1 starts spiking because everyone just goes, I'm going to stop employing people, or I'm going to make people redundant, all that sort of stuff. Then the government's like, oh no, we need to do something. We need to do some sort of helicopter money. We need some sort of, I don't know, they'll come up with some bullshit package like the job support scheme where they just, it's an excuse to print 500 billion or whatever. And then the printing happens. So technically, if this were to play out textbook, so according to, actually I'm going to go back to this chart here. If I was, gun at my head right now and I had to just pluck out a timeline, I would say we need 3 rate cuts, so that's 3 quarters of consecutive heavy cutting. So that would take us, mid-2025? During the next, from now until mid-2025, you should see parts of the economy starting to break. Like, the housing market hasn't popped yet, and it's very frothy. The US commercial real estate is already falling. That'll drag down residential with it. But again, that stuff takes time. When a person goes bankrupt, when a company gets liquidated or goes insolvent, it's not game over. It's a long, drawn-out process. For an individual to go bankrupt, that's really an 18-month process. It's 6 months of fanning around. Then you have the 12 months of being bankrupt. And then you're free. But with a company, if you liquidate a company, sometimes, especially a big one, Evergrande still hasn't sorted itself out yet. That happened, 2 years ago? 1 year ago? Whenever that was. So the bigger the company, the longer it takes to liquidate. So my best guess is, we start rate cuts like whenever the next FOMC meeting is, whenever the next US thingy. So we rate cut, rate cut, rate cut. Things break, they start printing Q1 next year. So maybe we have like a summer crash next year. Ideally, we'd like it to be end of 2025, preferably 2026. But I see Q3, big crash Q2 onwards next year. Anytime onwards, and if it's delayed, great. That's gun at head just for, but the beautiful thing with all these big crashes is that we will get crystal clear clarity probably 1 or 2 months before it happens because of some of these charts. So so the U1 chart will be a good one. That'll start spiking up. So I wouldn't be surprised, or don't be surprised if at some point next year, it could be early next year, where I go, I'm going to start taking some chips off the table just in case. So yes.
Yes, fine. So that's interesting. So if we press fast forward and we take money off the table next summer, what we're basically, because then you're taking money into an inflationary currency,
Yeah.
which isn't great, but the timing is we're taking money off the table, then the recession comes, and then you'll reinvest the inflationary currency, the US dollar,
Yeah.
into assets that perhaps are at fire sale.
Yeah.
Is that your plan and strategy?
Sort of. So I've got lots of crazy businesses I'm about to do in 2026. So until I start deploying capital into those crazy businesses in 2026, I'll need a vehicle to effectively sidestep. A chunk of that will be into the strongest stable coin at the time. At the moment, it's Tether. So I will go into Tether. Just, you know.
So you won't be coming into fiat, you'll just...
No, I want to keep as much in crypto as possible because until we have a mass regime change across the board, until we have someone crypto-friendly in America, whether it's Trump, JFK, RFK, or, you know, and in the UK is not friendly, but I guess if the US starts being crypto-friendly, let's say Trump gets in and they start going crypto-friendly, the UK is sort of going to be forced to be crypto-friendly because we are the lapdog.
And onboarding, offboarding.
Yeah, that'll get better, hopefully. But I know I always go on about how the dollar is dying and it's devaluing against everything, but over a long period of time, yes, I'll happily sit in Tether for 6 months. I mean, hell, during 2022, we spent more than a year in Tether. So yes, it's devaluing, but in the space of a year, it doesn't really matter too much.
Is there any asset class that typically is less reactive or responsive to a crash or a recession?
Sorry?
Is there any asset class that's typically less reactive to a crash, or is it just sort of...
Yeah, I don't know. I've mixed feelings. It depends. Every crash is actually quite different. So I want to keep as much in the crypto world as possible, so hence Tether. I am hoping to God this Casper fractal plays out, because if this, the price action at this Trap 5 breakout is irregular, but if the 1 to 7 fractals keep playing out, that is, I'm hoping, I think Casper could be our hedge, because Casper is moving to let's start again. The fractal cycle that Casper is going to is completely irrelevant to what Bitcoin's doing, which means it's completely relevant to what the overall, yeah, exactly. So my thinking at the moment is flop over to Tether, wait to a lull, 0.2, 0.3 of the Casper lull, and then maybe use Casper as the Noah's Ark or the hedge. And obviously, I'm very bullish on Bitcoin over the next 5-10 years, which means crypto. I won't really buy Bitcoin, but I use it as a barometer or a leading indicator, so to speak. So. Yeah, I actually think Casper would be a nice hedge, but we don't know for sure. But if we have another year, so this time next year, we'll have probably another 2 or 3 Casper fractals that have played out. It will give us more data. At the moment, the Casper fractals we're looking at, we're basically judging that on like 3 data points, which is not good. So.
Why would you hedge into Casper rather than Bitcoin, which is a much more solid, reliable, less likely to default for?
Because Casper and Bitcoin don't follow; they're not correlated.
But Casper is nowhere near as proven and as robust as Bitcoin.
True, but
So a hedge, is it not a risky hedge?
I don't think so, because it's the most. So when you look at it from a So technically, the only financial asset on the planet which adheres to the power law was Bitcoin. And now there's only 2. There's only 2 assets on the whole planet which adhere to the power law, Casper and Bitcoin. When you look at it, if you compare them like for like, Casper adheres to the power law better than Bitcoin does. But see, this is the funny thing. Because it's so new and because it has way less data, it should be way less correlated. But it's over a 0.95 R-squared regression now. So Casper has got 2.5 years of trading data, yet it's over 0.95 R-squared regression. Bitcoin has 12 years of trading data, roughly, and it's 0.95 R-squared regression. Casper, for some crazy reason, adheres to the power law better than Bitcoin does.
Did Bitcoin adhere to it as well in the shorter term scale, so you compare like
So you see, that's the thing. So because of Bitcoin's 4-year cycles and the halvings and whatnot, you have these massive oscillations or deviations, let's say, from the mean. So if you have the power law, yeah, Bitcoin has done this quite a lot. But for some reason, and I don't know why, Casper has a lower diversion from the mean from the power law, which I find incredible. I don't know why, but a year's worth more data would help. Now, my only personal spanner into this is that if the fractals break down, then I'm going to reject that theory straight away. But my overriding thought is I will hide in Tether until I see something good enough to go. And it could be something as crazy as, hey folks, I'm about to dump everything into Tesla or whatnot, because when you look at the real fundamentals behind Tesla and like what's in the pipeline, it's absolutely ridiculous. The moment he starts rolling out those Optimus Primes, Optimus Prime? No, Optimus. Sorry, I got confused. When he starts rolling out Optimus, it's going to be a game changer. And Figure, the other company, they got their announcement in like 3 days' time. Is it 6th of August? Yeah, basically this month is going to be a big update in lots of, well, yeah. Anyway, there was a question with Steve or Tom had over here.
What was his power thing?
The power law. You've missed a lot. Yeah, I'm going to have to send you some videos of that. But I'll show you a picture.
In short?
In short, wait. I'll try and find an old presentation. Stand by. If I go to P for presentations, go to R. I must have had it in the previous cuddle, so the PDF version, that'll be.
Did some good videos which are the Telegram group at that time.
Okay, I'll just, if I can't see it here, then come on. Power law. Ah, yeah, I did a whole thing on the power law, didn't I? So it'll be here. So long story short, everything in the universe adheres to the power law. Everything. Everything of a network nature. Even from the distance of the planets from the sun, all in the perfect power law. Fast forward to Casper. Oh yeah, look at this. So this was in 2018, this astrophysicist, Giovanni Santazzi, basically tried to see, are there any assets on the planet that adhere to the power law? And it was a big fat 0. And then just for shits and giggles, loads of people prodded him. Oh, what about Bitcoin? He did it, and Bitcoin had a 0.92 R-squared regression. So it had a 92% fit with the power law. And that was in 2018. And long story short, the power law has predicted the mean price of Bitcoin, because you can backdate, even though we've got the data, but you can look backwards at the power law, what it should have been, and you can always look forward. So long story short, if we fast forward to here, there we go, that's the better chart. So what we're saying, so what the power law is basically saying is that this cycle we should hit 200 to 250K plus or minus 50K. The 2029, so end of 2029 cycle, Bitcoin should be 500K plus or minus 100K. End of 2033, Bitcoin should be $1 million plus or minus 250K, which is great. Now, and it's just followed the power law beautifully. But Casper, come on, there must be a power law here for Casper.
You were asked to answer that puzzle.
Yeah, I've been. WhatsApp. Can I get WhatsApp on here? I'm just going to have to unplug quickly. So, yeah. Yeah, you don't, Steve has been sending me dick pics and everything. You don't want to see. So here we go. Web, link devices, link a device, use mobile data. Because I chat with Mikko Geno quite a lot, and he's finally done some new Casper charts, which I haven't shared yet, but I will. In fact, this will be the first time I'm sharing these charts, but come on. Sorry, it's downloading recent messages. Here we go. What's his name? Geno. Come on. Right. We're still waiting for the chats to update. We'll give it a moment. Still not there. Okay. Just wait a moment. Yeah. Any other questions whilst we're waiting for the pictures to load? Yeah.
Since I'm so far behind, I might talk about it. You've kind of alluded to the fact that come in next year, kind of, at least I thought you alluded to the fact that you kind of thought that crypto was kind of coming to an end as a kind of a journey, because obviously that's it, we're out of crypto. But you just talked about Bitcoin's 5, 10, 15 years in the future, and they don't seem to sort of fit nicely together. It seems to be.
Oh, no. It's not, no, so I play this cycle here. So I'll be selling Bitcoin or crypto, I'll be out of crypto for a year, that's it. 15 months, 15 to 18 months. So whether this is the last predictable cycle or not, but typically Bitcoin goes up crazy and it crashes for a year. So the plan is, if all in a perfect world, we see Bitcoin peaking plus or minus 23 days from the 1st of December, like it always does, and we all sell out in Q4 next year, then you literally sit on your hands, go into Tether, go into maybe Casper if there's a nice fractal low, and do nothing for a year, and wait for a 60, 70% drop in Bitcoin, and then we start allocating back into crypto 2027. So I'm not running away from crypto, God no. Just, this is sidestepping.
So when you say last predictable for now, or you're not worried about the fact that we less predictable in the future, that's just something to worry about?
What was that last bit?
So you said I think you used the phrase that this could be the last predictable
Yeah.
run.
Yeah.
Are you saying, is that for the time being, or is that?
I think forever, because I think there's two things really. I think this is the last predictable Bitcoin cycle because we now have BlackRock involved. BlackRock owns pretty much all of Bitcoin now. It owns a huge percent of the private miners, huge percent of the public miners. It owns a huge percent of all the exchanges out there. BlackRock effectively controls the SEC, and it's got the biggest ETF. So if I'm BlackRock and I now own huge parts of the Bitcoin infrastructure, I will want to see Bitcoin do well, but not too well. Because I've got all these different ETFs. All I want Bitcoin to do, if I'm Larry Fink, is, if the S&P 500 grows roughly 30% a year, I want Bitcoin to go 50% a year, but that's it. I don't want it to do like 200-300% growth and then crash 90%, because that's going to scare all of my clients. It'll scare all of my ETF holders, because BlackRock makes money as an expense ratio of AUM, so assets under management. So if Bitcoin can just grow 50% per year, or at least a 20% alpha on the S&P 500, they've basically locked in huge amounts of profits for the next 50 years, 100 years. And they have enough control of the wider Bitcoin ecosystem to basically force a 50% growth per year, roughly.
How does that
And
relate to this law, the power law? You're saying the power law.
oh, the beautiful part is that it's irrelevant. It is completely irrelevant. So what I think is that the 4-year cycle halving, I think this could start to plateau a lot. And I don't think we'll see 70% crashes in Bitcoin ever again. It's going to, because BlackRock won't want that. They will want a soft deflation, a soft whimpering of a bear market, not like a. Wait 1 second, just finishing this question. So I think this cycle will flatten out a bit, but the power law, it's irrelevant. So you could take every massive calamity that Bitcoin's ever had, and the power law is somehow accounted for that. It's also accounted for the massive adoption in market cap. I don't understand how it works. It just does. Yeah. Yeah. Sorry, yes.
So all I was going to ask is, if BlackRock are now such a massive player on Bitcoin, on one hand that can make you nervous because they can manipulate like mad.
Yeah.
On the other hand, what you're saying is they actually want stability.
Yeah.
That's better for them. So then they're actually maybe made the market more stable and more predictable and less volatile.
Yeah, they'll protect it. They want to lock in those juicy fees that they get. But I've also got a counter to that. I think BlackRock will do everything they can to stabilize the volatility. But then I think when the dollar finally starts collapsing and and we get hyper Bitcoin, I can never say the word, Bitcoinization, whatever that word is. I do see a point where BlackRock's control will suddenly just be completely irrelevant, and there'll be a run on the dollar, and where everyone will be like, I need to, or run out of the dollar. They will be like, I want anything other than the dollar, and they'll look around the world and go, right, what's good? And people will naturally flock into stocks and property or prime real estate. But I think there's this ever-growing bubbling of Bitcoin. People going, oh shit, Bitcoin is the only thing that is, the long-term wealth preservation. So yeah.
What's actually the CAS power law chart?
Has my thing updated yet? Chat sync.
So would you say that cash was less volatile on Bitcoin because there's fewer deviations from the power law?
No, in real terms, it's more volatile still, because you'll still get but in terms of the power law, it just adheres to it better. Wait a minute, if I can just send myself an email, that'll probably work. Here we go, Gano. Aha, here we go. So you probably can't see that very well. In fact, seeing the labels, so this is Casper and the power law. So it's still volatile. It still has big crashes and big booms, but this is the power law. It is following up this power law rather nicely. And for me, the risk, so if we can just keep the chat down, guys. For me, the risk-to-reward ratio of having even a small punt in this is just obscene, because if we just take this yellow line, which is, let's say, the average, if we just fast forward, let's say, to 2027, which is not that far away, is it? We're looking at a price of $6.50. That's huge. So even if you're looking in the short term of $6.50 in 2027 as an average price there, you can then just work this out and go, wait a minute. So $6.50 divided by, 19 cents or something like that? That's an easy 34x for just being patient. So if you wanted like a longer term or even a short term sort of insurance policy or a hedge of some sort, just, 10 grand now is, 34x in 2027. But the crazy thing with Casper, which I still struggled, and I admit I struggle to believe this number. Remember how so by 2030, which really is only 6 years away, or less than 6 years away, look at that yellow line. That yellow line is at $38. So $38 divided by 0.19, that's a 200x from here. So part of me is thinking, okay, well, does it hurt to squirrel away 50 grand and just not touch it? Screw the cycles, screw the stock market crashes, screw everything. Can you, squirrel away 50 grand of Casper now, which is at 19 cents, that's like 263K worth of Casper. So, and then times, what was it, $68? You're looking at 17.8 million quid. So there's a big part of me which is thinking, wait a minute, as part of my portfolio, maybe I just never sell the Casper chunk. And I know there's lots of people in RT that have, I can think of like 10 people straight away that have more than 10 million Casper. And so when I do the maths of 10 million Casper times 68, that is ridiculous. That's $680 million. So this is like silly numbers, which is why I struggle. Anyway, so I think you should have Casper just in case this actually is right. And it's the same with Bitcoin. If you look at the Bitcoin power law, you should have some Bitcoin just in case Bitcoin is also the Bitcoin power law still comes true. Right, there was another question here. Sorry, did I? No. Any other questions? Are we back on track? Yeah, I think so. Right, so no, we're still early. Yes, go for it.
If the power law applies to everything, why?
Most things of a network nature, yes.
Why aren't there more assets?
And that's a question I asked Giovanni Santastasi because, so if you go back to, sorry folks, I'm going all over the place here. So, blah, 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 blah. Right. Here we go. So basically, it applies to, what did he say? So anything of a network nature is most likely going to adhere to a power law of some sort. Power laws are different. You have different types of power law because they're different. You have sublinear scaling and superlinear scaling. And the question which I personally haven't had an answer to is, technically a company is a network, isn't it? A network is a bunch of people all working together, communicating with other people in other companies. So technically, stocks should adhere to the power law, but they don't. The S&P 500, which is a network of lots of, is 500 companies, all networking with each other, no doubt. The S&P 500 doesn't adhere to the power law. I don't know why. It should. Like, if you take big companies like Google, Tesla, they, in theory, should be a power law, but they don't. And that's funny, yeah, because I chat with Giovanni. I still chat with Giovanni, and I think I'm becoming that annoying thorn in his side, going, "Have you tried this? Have you tried this one? Have you tried?" And he does indulge me sometimes, but it's got to the point now. He's like, "Siam, no financial asset adheres to the power law. I've done enough for your charts already. Just Bitcoin." And he still refuses to admit that Casper also follows it. So,
what's the difference with the power law and the Fibonacci sequence? Relatively similar.
No, the Fibonacci sequence is 1 plus 2 equals 3, 2 plus, it's the, yeah, it's the golden ratio, isn't it? Exactly. So that is of a, I don't know is the answer. Yeah. I just know that in nature, many things follow the golden ratio.
It's got to be, yeah, it's got to be designed sort of with a similarity in that.
Quite possibly.
Well, network related though, rather than pattern related.
Yeah.
So, and maybe it's down to the degree of connectivity within the network, which is why it will or will not meet power law. There must
Maybe.
be some critical mass of
Yeah.
connectivity in the network that's required, or influence between the elements in the network to create or map to the power
Yeah,
law.
I think it's the miners which give it the most, like Bitcoin is way more network-like than, let's say, a company, because we have a whole distributed, decentralized grid of miners all over the world. We have buyers of Bitcoin all over the world. And the emissions curve, so with all that combined with the emissions curve, I've just got more questions than answers, unfortunately. I'm just like, yeah, but the more I study it, there's a power law in everything. So the pioneer of the power law is a scientist called Geoffrey West, who's spent the last 20-something years studying the power law. And he's also got many, many examples of where the power law applies to stuff with no network nature. So this is, in fact, there's a documentary, it's on YouTube, there's an hour documentary about Geoffrey West. And he was saying that like you could get a handful of sand and just slowly spill the sand on the edge of this table here. And you'll say that the cascading effect of the sand falling off the table adheres to a power law as well. And he's proven it. And he's proven so many other things in, that also have a power law which has no network effect. Like, you know, dropping sand on the table and that falling off. So the rate and how the sand will build up and then it cascades off is a power law. No, but the way it does it, so like he was saying that, so a lot of these charts are from Geoffrey West. Like even the rupture area of earthquakes, it follows a power law. To the number of wars and deaths is also a power law. Yeah, there's loads. So, and yeah, I don't have many answers, unfortunately. I'm just an idiot from Norwich.